Good morning, everybody. Let me first start by saying thank you for joining us in this virtual context. I wish that we could all be together in person, but in the absence of that opportunity, I'm really looking forward to the conversations that we're going to have over the next few days. My name is Lauren Goodwin, and I am an economist and the director of portfolio strategy at New York Life Investments. And let me just go ahead and get my screen shared here so we can start our conversation. So, New York Life Investments is comprised of the global asset management business of our parent company, New York Life Insurance Company. We offer clients access to specialized investment teams through our family of affiliated boutiques, and that includes public equity and fixed income, as well as private equity, private credit, and alternative strategies. I have the enormous pleasure of kicking off today's session with an enormously difficult question, which is, amid all the cross currents that companies and investment teams face in this environment, what can we expect to happen next? Now, a quick context reset. When I last met many of you, it was at Super Return Los Angeles in February. And at that time, I told you that I was concerned that the year could be highly taxing on investor nerves. The reason for that is that the economy was already vulnerable to shock. Valuations were high, profit margins, which is what you see here on the slide, had been lower than reported for several years. And we had headwinds from China's growth slowdown, as well as trade and manufacturing recessions here in the US. And so as a result, I spoke to defensive positioning in investor portfolios, a focus on careful management selections, appropriate capitalization, and real value add in the marketplace. The direct cause of the next crisis was completely unclear, of course, but many of us were concerned in our discussions in that session that what an impact to Main Street, as different from an impact to Wall Street, which is what really kicked off the 2008-2009 financial crisis, could come to call on private equity and private credit in the next recession. Well, of course, we had no idea what would happen just a couple of weeks later, but now we do all know exactly what came next. COVID-19 first infected China and then the globe, with serious implications on all levels of the economy. And in response, sizable and swift policy support from the Federal Reserve and Congress has been made. Now that support, and it's important to call it support rather than stimulus, helped to forestall some of the worst possible outcomes from the COVID-19 crisis. But now investors find themselves in a truly unprecedented predicament. And I don't use the word unprecedented lightly in times like these. But with cross currents as powerful as the ones you see on the slide here, how can we possibly determine what will happen next? Now, that's what I'm going to try to do here in the next 25 minutes or so. And we'll focus on 4 key questions. Will there be a long recession? How is private equity faring in this environment? Which sectors, strategies, and asset classes are likely to benefit or at least survive in this environment? And then what are the risks? So starting with that first question, what can we expect from the economy next? Or perhaps put more candidly, when will this be over? And I have to say, I think that it's really helpful to think about this crisis in 3 stages. And I cannot claim total copyright authority over these 3 stages. They're exactly the same ones that Fed Chairman Jay Powell uses, but I think it's really helpful for considering the real economy in this environment. We've already talked about stage 1 a little bit, the shutdown. Sharp declines in economic activity and large increases in unemployment have defined the last several months. Declines in real GDP in the second quarter were more than 35%, the worst result ever on record on an annualized basis. And the burden of this downturn has not fallen equally on all American households or companies. Instead, those least able to withstand the downturn and companies that had the least ready access to capital have been affected the most. And since then, we've seen a meaningful economic rebound, albeit from a very low base. That's the "you are here" stage 2 on the slide. As the economy reopened, data has bounced back in a big way. And just a quick illustration of that bounce back, a strong rebound doesn't necessarily mean that things are back to normal. High growth rates from a low base can still mean your overall activity are actually lower than pre-crisis levels, and that's exactly what we're experiencing now. Now, what you see on the slide here is just an illustration. It's not using real data, but it's meant to demonstrate that even the exact same percentage decrease and increase could leave you significantly lower level of economic activity than you were before. So here on the slide, you see we start at a level of 100. If we fall 50%, we get to 50. Increase 50%, we get to 75, and you get the point. We're still 25% below the level where we were before. So just because we've seen a rebound in activity doesn't mean that we're out of the woods. And so that brings us to stage 3, the recovery. And the question is, where will we go next? This third stage of the crisis is much more uncertain. And even though economic activity has improved, it's pretty difficult to get back to 100%. And as long as the virus is with us, investors will face a low conviction and very confusing economic environment. So we hear about the shape of the recovery, what that economic environment might look like. And I'm sure you've heard the V, the U, the L. I've heard a Y, a square root, a K, and we'll come back to the K because I think it's interesting to think about for investment implications. But at the end of the day, no one really knows what the path forward looks like. That said, we've identified 2 key factors that matter for the shape of the recovery. 1, what is the path of the virus? And 2, how effective is policy in keeping the economy going and keeping people anchored to their places of employment? These 2 factors have the highest impact on consumer confidence and business activity, and therefore company profits and ultimately investment strategy. So using these 2 factors, we can much more easily chart the economic environment moving forward as we get new information. And I use this simple framework of 2 factors because 1, these are the true drivers of the investment environment. They're also easy to keep track of, but 3rd, it's a powerful framing mechanism for filtering all the news and different impacts we hear about in the day-to-day. Thinking about the economy in terms of the real drivers is incredibly useful for distinguishing signal from noise. So then using these 2 key drivers, I have my own set of base case expectations for the economy, but you can use the same information based on your own expectations and make business decisions from there. And then if the virus or policy efforts end up better or worse than we expected, we can toggle our expectations to a more optimistic or pessimistic direction. So just to put a stake in the ground, on balance, my view is slightly more conservative than the prevailing market media consensus in the economy. And that view acknowledges that policy support has been enormously effective in eliminating the worst case scenarios for households and companies, but the virus impacts on the economy are going to stay with us for some time. And that means that social distancing measures will be necessary over the medium term, and some groups of the population won't be able to engage with the economy. It's not just about rules and restrictions, by the way, on this front. Data show that fear of the virus, rather than any specific government mandate or regulation, are what are keeping people at home. Even just at the highest, most basic level, if you put together people over the age of 65 and people with confirmed cases of cancer or immunodeficiencies, that makes up 24% of the US population. And that doesn't even include those caring for or living with those people. So in economic terms, that means that investment and consumer spending will be lower than potential, or at least different from what they used to look like for some time. I anticipate that a full recovery could take 2 years or more, which creates a drag on consumer prices that we're able to charge, corporate profits, worker wages, and consumer spending. But what if we're wrong? I don't have a crystal ball any more than anyone else, and there is a lot of uncertainty everywhere. A better virus or policy outcome would move us in a more optimistic economic and corporate scenario. And of course, by the same token, a worse report card on those fronts would point to a more extensive and prolonged corporate default cycle. So again, the idea here with those 2 drivers, the virus and policy, is to allow you to make your own decision about the path forward, especially as things change in the weeks and months ahead, as we know that they will. Now, just a couple of additional macroeconomic points that I'd like to make before we talk about private equity specifically. And the first of those is about the ever-present search for yield. COVID-19 is the really important thing going on in the economy right now, but it's not the only thing impacting investor perspectives, particularly for the funders of investment strategies. One thing we've heard fairly consistently across the marketplace is that fundraising is difficult in the COVID-19 environment. Instead of looking outward, investors have looked inward for the past several months, and with good reason. It's been valuable to take stock of the environment, wait and see a bit, and consider the world after COVID and what that might look like before making any incremental investments. But I wouldn't expect that inward-looking focus to persist forever, and indeed, it's starting to shift a bit already. Ultra-accommodative monetary policy is here to stay, and lower for longer interest rates are hardly a new trend. You can see on the slide that the 10-year funding rate has been moving lower for decades, and even more than a century if you take a big picture view, driven by things like demographics, technological change, slowing economic potential over time, and then of course, in certain cases like today, exacerbated by the economic cycle. But that means that the same challenge we've been discussing in the industry since the great financial crisis is likely to continue. And that is that with yields so low, how can investors, especially investors with long-term liabilities, meet their obligations if they're not investing in private asset classes? So we anticipate that private assets will continue to be a part of that storyline, and that demand for those strategies will continue to be in vogue as this crisis starts to lift. Now, the second thing I want to point out is how this lower for longer interest rate dynamic plays into how companies access funding. Debt and indebtedness have been a major source of concern for investors over the past several years, even before COVID-19. And COVID-19 has contributed to many companies raising a lot of money and increasing their debt levels in order to bridge the gap created by the virus. Now, when you see the left-hand side of the chart here, this is corporate bond issuance and borrowing from banks. So bond issuance is in blue, borrowing from banks is in orange. And as you can see, the volume of that activity was simply massive in Q1 and Q2. And that's not only true on the aggregate. The second quarter saw one of the highest ever levels of junk bond issuance by specifically PE-backed companies at more than $31 billion in the quarter, according to Dealogic. So that's the sixth highest level for any quarter on record and the highest since 2014. Now, that isn't only a bad thing. Many companies actually aren't spending this cash. They're using access to cheap and accessible debt capital markets to create a buffer against upcoming risks. And that in many cases is good management. But of course, not every company has this luxury. In fact, just to throw another fun fact at you, firms with annual revenues above 1 billion or more have come to dominate corporate issuance, rising from about 45%, according to the Bank for International Settlements at the beginning of 2020. So 45% to start the year, now closer to 80%. So to summarize this idea, lower for longer interest rates mean that companies are raising money. Those companies who have been able to raise money are the ones that have been able to bridge the gap created by COVID-19, and therefore they're the ones generating return for investors. For the economy as a whole, though, the picture looks like there are slightly more losers than winners. So just to bring our macroeconomic perspective back to where we started, this is the exact same chart of profit margins that I shared at the beginning of this presentation and again back in February. And what you can see is that even as a proportion of overall GDP, which again, we know declined by 35% on an annualized basis in Q2, even with that declining GDP growth, profits as a percentage of that economic activity have continued to fall even lower. So if we were already concerned about company profitability and what it meant for companies' ability to withstand shocks, this fact that company profits on aggregate continue to decelerate has us very concerned. So what I expect over the next 6 to 12 months is a slow but steady credit default cycle to play out. We expect that default rates will rise to and potentially beyond great financial crisis levels of around 10%. And that has implications for investment strategy, which companies will outperform, and the care that we need to take in our portfolios, which we'll get to in just a minute. So now with that macroeconomic background behind us, where does that leave private equity? What has that journey looked like to date? Well, just like we can think about the economic trajectory over the past 6 months in 3 stages, we can also think about the private equity journey in similar stages. During the economic shutdown, private equity focused on portfolio management. It was time to gather information and assess where portfolio companies stood in a full-scale economic shutdown. So investors and GPs were thinking in terms of who would be the beneficiaries from this environment, who might be affected but would probably manage through, and who, on the other hand, would be seriously affected or almost certainly closed down. Now, since then, thankfully, as the economy has rebounded, again, that was the second stage of the economic activity that we've seen, private equity has stabilized. New deal flow has been admittedly very slow, although managers that are able to get out there and do some due diligence are finding good deals. And this makes sense. There's not many firms that have the backing or risk appetite from their funders to get out there and get deals done. So there is opportunity for the few who are able to do that. In the meantime, many GPs and LPs are focusing on portfolio management and on providing funding where appropriate and necessary, which again means identifying the companies that will be potentially impacted but able to survive this environment given that additional capital. Expense control is another area where investment teams are focusing in order to add value. And fundraising is probably toughest. At this point, it's mostly leveraging prior relationships to get any fundraising done, which is why forums like this are so helpful in such a difficult environment. So if this is the environment that you've been facing, you're not alone. I regularly poll our private equity and private credit portfolio managers and find that this is the average position. But that brings us to the next big question, which is what's going to happen next? Which strategies are going to thrive in the new normal environment? Now, as we transition to this topic, I will give a brief but shameless plug for a piece that my team recently wrote that gives 7 ideas for the future state of investing. You can find it online, and I'll see if we can't put it up with the materials in your portal. And it focuses on big themes like the future of cities, investment strategies for the next generation of data use, globalization, etc. But we're basically going to get into those concepts today. So just as a brief primer, I mentioned when we talked about the shape of the recovery, a K-shaped portfolio, and you can kind of see the K here on the slide. But what that really means is that COVID-19 and the particularities of the COVID-19 related crisis have created real and pronounced winners and losers in this environment. We call it a K-shaped reality where COVID-resilient business models, skilled managers who focus on value add and have well-capitalized companies are actually benefiting from this environment. On the other hand, COVID-vulnerable business models, or companies that have to rely on consumers or mobility or foot traffic in particular, those who are poorly capitalized or those who have high costs of credit are really struggling. And as long as this virus is with us, these trends are likely to persist. And again, considering the vulnerable populations in the economy, the virus can be with us for 6 to 12 months, even after a treatment starts being distributed. So K-shaped portfolio, winners and losers. Let's just play this out with one example of how this crisis can transform business opportunities. If this is going to be our reality for a little bit, what can we think about to shape a portfolio of the future? And I'll give one example. I really love this example because it sounds pretty obvious in this environment, but it's actually full of surprises. And that's the example of digitization or e-commerce. So let's think about online sales and really think about it with me for a second. How much of total sales do you think is taken up by e-commerce or online sales? And let's actually start with history. Let's think about 2010. What would you have expected e-commerce as a percentage of total sales would be in 2010? 4.6%. That's tiny. That was an enormous surprise to me. But you know what's even more surprising? That number, that 4.6%, had only increased to 11.3% by the end of last year. So in 10 years of online sales, in which the internet has felt like a dominant part of our lives and the business strategies that we invest in, online sales grew by less than 7% of total sales. Now, look at this. In the first quarter of this year, e-commerce reached 11.8% of total sales. So that's a 0.5% or 0.5% jump between Q4 of last year and Q1 of this year. That's a pretty big increase when you think about the fact that it took 10 full years or 40 quarters to grow 7% up to that point. Well, in Q2 of this year, that number was 16.1%. That's 4.8 percentage points above the long-term trend and 4 times the growth rate of any other period since e-commerce became something worth tracking in the late 90s. Now, the obvious takeaway from this data is that digitization and e-commerce were pre-existing trends, growing on a steady basis even before COVID-19 hit. But since COVID-19 has forced many people to work and play from home, firms that were able to grow on a steady basis prior to COVID-19 and that are leveraging those pre-existing trends have survived and even thrived. So we might call them winners or beneficiaries of the COVID-19 environment. But why stop there? Again, that's a relatively straightforward example, and there are so many other ways that this plays out. Even before we get to this slide, just think about how many private equity strategies are focusing on improving digitization and improving management software within the confines of a portfolio company. Now, think about office space. Some point to work from home and online capabilities as a reason why companies will need less office space in the future. And for some, that's going to be true. We expect some companies to adopt more flexible work arrangements with implications for commercial real estate, as just one example. But it might not be all bad. Total occupancy might fall, for example, but there might be more space required per worker. And some geographies might suffer, but others might benefit. So what does that teach us? Just on a high level, no asset class is going to be a full loser. Companies that can leverage these trends and adjustments are going to be able to create real value. Shifting then to the retail experience, lockdowns have also accelerated a trend away from brick and mortar retail and towards online shopping, which we just explored. On the face of it, this trend appears to be negative for commercial real estate as well. But even here, there's winners within the space. The biggest winner of all is the industrial real estate, which can be recommissioned and repurposed for warehouse distribution facilities that service those online sales. In other cases, tenants will innovate. Retailers will increasingly use retail locations as just one piece of a larger customer acquisition puzzle. A focus on things like flagship locations or in-store customer service or virtual reality enhanced experience could become the norm. Data collection and analysis. The speed of the Great Lockdown's onset forced investors and policymakers to consider completely new types of information to track its impact. From an economist perspective or from a market analyst perspective, which of course is where I sit, we were looking at health and airport security data and traffic data to gauge the impact of the virus more quickly than traditional economic indicators that we've been using for decades could. Social media's role in advertising, customer acquisition, and purveying public opinion has also leaped forward as individuals seek health updates and state and local government information or protest locations all from their couches. So looking ahead, the ability to retrieve or process or analyze or visualize or make decisions from this data are going to be essential capabilities. And so investors and policymakers alike will need to invest in and be more agile in their analytic methods. And then just one more example, data protection and surveillance. A rapid and widespread transition to remote work has left corporate and government data even more vulnerable than we considered it before, because folks are using at-home routers and mobile devices, which increases the risks that company or customer data could be accessed or exploited by the wrong groups. It's also possible that a transition back to work could create similar challenges if we're taking temperature checks going into the office, that type of thing. It's going to be important to keep this data secure, which again creates opportunities for companies that are servicing this type of need. So again, digitization is a really straightforward example of how COVID-19 has changed the world. But this list is only getting started of the different opportunities that companies have to leverage, again, pre-existing trends, which have now been accelerated by the COVID-19 environment. So again, take a look at that piece on investing after COVID. It's full of ideas like this of which industries might benefit and how it can spoke out into different opportunities. But finally, a brief note about risks. Since COVID-19 is such an overarching risk, it can be easy to forget the other elephant, not to make a pun in the room, but that's the election. And with the conventions now behind us, the election is likely to be all over the financial media in the coming weeks. And so there's just 3 brief thoughts that I thought would be helpful to share about this, since it's from a macro perspective likely to be top of mind in the coming quarter. The first is that there will be some chop in the public markets. And this might be coming at somewhat of a bad time as we're just starting to get our feet under us from the COVID-19 crisis. Markets just don't like uncertainty, particularly around structural policy issues like taxes or regulation. And so as a result, investors should expect that market volatility will happen leading up to the election. This volatility, though, tends to resolve in the short form, which is what you can see on the chart here. My team recently staged a review of the last 100 years worth of elections, and that shows us that actually equity markets are just as likely to move up in the 90 days leading up to the election as down. So over 100 years, that's 23 presidential elections, and markets moved higher 12 times in the 90 days leading up to the election, and lower 11 times. So we can expect market volatility. It's unlikely to be a major driver over the rest of the year. So the second thing I want to point out about the elections is that markets don't ultimately really care very much about them. This is a very busy chart, and it'll be posted up on the portal after the presentation. But suffice it to say that across all different types of combinations of congressional control, presidential control, and this and that, it actually doesn't make that much of a difference for market return. Actually, Democratic presidents accompany better equity market returns than Republican presidents on average. But over a long period of time, it's so even Stevens that the result isn't even statistically significant. But that's for public markets. For you and for investors generally, the point is to ignore political promises. Those are not what tends to matter for the market, and instead focus on real policy change and where that real policy change might come from. Remember, only 2 main things matter for a durable investment strategy right now: the virus and the policy response. So it's all about the real policy issues at hand. That's what matters for sector choices of what will outperform. It's what matters for the markets as a whole. And the investment environment is driven by real economic factors. So the election only matters insofar as it impacts those real factors. So expect a little bit of volatility, but stay focused on policy over politics. But that brings me to my final point about the elections, and that's the fact that there is one major policy change that could impact the private equity industry, and that's taxes. Now, there's all kinds of reasons why taxes may or may not happen. Even if Biden is elected president, depends on who's in control of Congress and all kinds of other policy priorities that might change this, including the ongoing economic crisis. But the effective tax increase that's on the table is meaningful. This chart illustrates the step up from the middle column, which is our current law effective tax rate, to what it would look like under Biden. And remember, there's a difference between something that's being proposed and something that's real, but I think it's worth entertaining this idea because it matters for corporate profitability. And that's ultimately what good investment teams are for. Assessing what will matter and which companies will be impacted is the bread and butter of our industry. What I expect, though, will matter for many folks in this group is the personal impact of those tax changes. And there's several things on the table, but the one thing impacting private equity the most is changes to capital gains tax. 2 changes on the table. On the left side, you see there an increase in the capital gains tax rate. So for households making $1 million or more, that capital gains tax rate increase would move from 20% to nearly 40%. And the second thing you see on the right is an elimination of step-up basis, which is the ability to pay capital gains on a lower tax amount of your total gains. Biden's proposal on the table right now would mean that your heirs would pay capital gains on the full capital gains rather than just the gains since you bequeathed it to them. So obviously this matters. And I'm already getting a lot of questions about whether it would make sense to sell a company now if you were planning on doing it in the next 3 to 5 years anyway. But look, there is a lot going on right now that would impact the attractiveness of selling a business besides just this potential, and again, potential tax change. We just talked about pretty major economic crisis that we're in the middle of, and premature sale can have trickle-down impacts on all different aspects of your estate planning. So for business owners, this is really what your financial planner is for. For investors, there might be some circumstances where assets are on sale as a result of this dynamic. So just something to keep in mind. So there you have it, folks. Will there be a long recession? No. In fact, the recession officially is already over, but economic activity overall won't reach its pre-crisis levels for another 2 or maybe 3 years. And that has important implications for investing. It'll create winners and losers across the economy and across financial markets. Private equity itself is stabilizing, but there's very few new deals getting done right now. So until we can travel and do our due diligence, or do our due diligence in a different way, and until financing is willing to take on more ready risks, this might stay the case. That said, lower for longer interest rates mean that this day is likely to come. And companies that are able to leverage pre-existing trends will be those that thrive in the post-COVID world. So I hope that you've enjoyed this presentation today. Let me just bring my video back. If you have enjoyed these insights, again, I mentioned that we have a piece on investing after COVID that I think would be helpful for some in this group. It's available online. We also have a weekly podcast, and please feel free to reach out either in the sessions over the course of the next couple of days or on LinkedIn. You can, of course, find me there. So thank you so much for your attention over the past 30 minutes. I hope that you have a great session today and tomorrow, and I look forward to connecting to you then. Take good care.